Our mission today is to take a stack of truly contradictory source material data points that frankly shouldn't coexist and try to synthesize them into a clear thesis for you. We are plunging into the high-stakes world of Roblox Corporation, ticker RBLX, and really examining the conflict between truly explosive growth and, well, seismic financial, legal, and internal selling pressure.
This is one of the most interesting deep dives we've done, I think, purely because of the breadth of the conflicting signals.
Right.
You've got sources showing a company hitting unbelievable engagement records, but at the same time, it's dealing with a major lawsuit filed by the Florida Attorney General. It's a mess of signals.
Okay, so let's start with the spectacular, the undeniable side of the ledger, the growth metrics, specifically from the third quarter of 2025. I mean, these numbers are genuinely historic.
They really are.
Daily active users, or DAU, hit 151.5 million. That is up 70% year on year.
And it's not just the volume of users, it's their dedication. Total hours of engagement, it reached 39.6 billion. That's a 91% jump year on year.
Wow. That kind of engagement surge shows the platform is just succeeding wildly at holding user attention.
And the dollars are following the users. Q3 revenue came in at $1.36 billion, marking a 48% increase.
But the bookings, which is maybe even more important for a business like this.
Right. The bookings were $1.92 billion, up a staggering 70% year on year.
So by every traditional metric for a growth stock, this company is accelerating. It's hitting new benchmarks. It's validating its global platform model, which it leads us to the central dilemma we have to resolve for you.
Exactly.
How can a stock with these exceptional, unprecedented growth numbers be trading around, what, $83.91, while facing major legal action, seeing a massive insider exodus, and, earning a strong sell rating from technical analysts?
That is the tension. That's what we're here to analyze. We need to find out which of these fundamental signals is going to prevail for the market, because right now you have one half of Wall Street telling you this is a rocket ship, and the other half is signaling a complete abandonment.
A total disconnect. So let's begin by mapping out those two extremely different perspectives. We're calling it the tale of two narratives. Analyst hype versus the insider exit.
Okay.
Starting with the bulls. The consensus from investment analysts is remarkably strong. Our sources show 15 firms have issued buy or outperform ratings.
Critically, 0 sell ratings, not one.
0. That optimism flows directly into these dizzying price targets. The median analyst target is $159.50.
Just think about that for a second. From the current price, that suggests a spectacular upside. Some firms, like Goldman Sachs, are even going as high as $180.
And that kind of conviction isn't just theoretical, right? It's backed up by institutional action. We saw 611 institutions adding shares last quarter. Look at JPMorgan Chase, for instance. They added over 15.7 million shares in Q3. That's an increase of 374.3%. That's a massive vote of confidence from sophisticated money managers.
But that institutional confidence is immediately just smashed by what we see as a seismic contradiction.
The insider.
Yeah, the insiders. The people who have the most intimate knowledge of the company. The executives, the board members, they are selling. Relentlessly.
Over the last 6 months, insider trades tracked show 175 sales and precisely 0 purchases.
0 purchases. Not a single executive bought a share.
And these aren't small, scheduled sales for tax purposes. Headlining this exit is the CEO, David Baszucki. He sold over $331 million worth of stock.
That's over 3.4 million shares. It's a massive divestment from the person at the very top.
And if we total up the selling from all the key executives over the last half year, the estimate is over $430 million.
Which raises an absolutely vital question for you to consider. Is this simply scheduled liquidity, planned well in advance and totally benign? Or, given the volume and the breadth of who's selling, is this a powerful leading indicator of internal risk that Wall Street analysts and, big buyers like JPMorgan are just fundamentally ignoring?
It's so hard to reconcile that. The institutional buying with a technical sell rating. If JPMorgan is buying 15 million shares, they must be banking on some catalyst that the technicals are ignoring.
But those objective technicals, they certainly align with the pessimism of the insiders.
Oh, absolutely. StockInvest.us rates RBLX as a strong sell candidate.
Right. The indicators, things like moving averages, both long and short term, the pivot points, they're all signaling negative momentum. The technical perspective isn't neutral, it is overtly bearish.
And the quantitative forecast for the next 3 months is genuinely brutal. It's predicting a fall of mid 37.19%,
Which would put the stock where?
potentially holding a price somewhere between $45.72 and $61.17.
Okay, let's just sit with that for a moment. You have bull targets up to $180 and technical bear targets down to 45s.
Yeah.
That $135 range between the most bullish and most bearish projections tells you everything you need to know about the market's confusion right now.
That extreme spread means you, the listener, have to decide which signal to trust. Do you trust the analysts modeling future growth, or the insiders voting with their feet and the technical chart that tracks the price?
And it is worth noting that not all analysts are drinking the Kool-Aid here. Christopher School from UBS issued a neutral rating. His target was way lower at $103.
Right, back in December.
Yeah, and that outlier target suggests some analysts are trying to factor in risks that others are maybe just sweeping under the rug.
So if that $430 million in insider selling is our first indicator of internal concern, then the next question is what external pressures are driving that fear? And that leads us straight into our second major conflict, the strategic tax. We need to talk about the legal and safety issues that are fundamentally changing the company's cost structure.
The most immediate weight, for sure, comes from the renewed high-profile scrutiny over child safety.
The Florida Attorney General.
Exactly. They filed a significant lawsuit in December 2025, specifically accusing Roblox of misrepresenting its safety measures and, failing to protect minors.
And these state-level actions, unfortunately for Roblox, they give immediate weight to the claims made by the Hindenburg short seller report back in October 2024.
Right. Whether those claims were technically correct or not doesn't even matter as much anymore. The compounding of legal and regulatory action raises the reputational risk to a critical level.
Okay, so how does that external legal risk translate directly into their financial guidance?
Well, despite that massive 48% revenue growth we started with, the company's net loss actually widened to $257.4 million.
It got worse, not better. And crucially, management guided for even larger losses in the fourth quarter.
Right, so this signals very clearly that profitability is not an imminent goal, and that widening loss is driven by a non-negotiable high-cost investment. It's the price of achieving platform viability.
We're calling this mandatory spending the strategic tax.
I like that framing, because these aren't optional R&D projects. They are calculated, unavoidable costs necessary for long-term survival and, frankly, mitigating more legal action.
So what are some of these expensive initiatives?
Well, one of the biggest commitments is adopting AI-based facial age estimation technology by the end of the year.
To gate communications.
Right, exactly. That's a massive infrastructure expenditure. They also announced a high-profile partnership with the Attorney General's Alliance on a Child Safety Coalition.
And they're adopting the IRC rating system, raising the minimum age for restricted content to 18. That feels like a fundamental shift in how the platform operates.
It's huge, and the CFO warned that the margins are expected to decline slightly in 2026. He cited the combined impact of higher DevEx rates and safety spending.
So for the listener, what exactly does a higher DevEx rate mean? That's the rate creators convert their in-platform currency, Robux, to real dollars, correct?
That's precisely right. So a higher rate means a larger portion of revenue is flowing out to the creators, who already had a record $427.9 million in Q3.
So the safety spending is basically consuming any efficiency gains that might have otherwise boosted their margins.
That's the key. The CFO said it was limited cost to serve improvements due to safety. The connection is direct.
So management is implicitly betting that the cost of not achieving the safety standard is higher than the cost of losing short-term profit. They're intentionally paying the strategic tax.
The connection is key. Legal risk forces mandatory spending, and that spending structurally prevents margin expansion in the short to medium term. Management is accepting short-term pain for long-term viability.
Okay, so now we transition to the quality of that explosive growth. We can't deny those high volume numbers. Let's look at the global growth engine again, focusing on that international acceleration.
It is a remarkable geographic achievement. APAC, the Asia-Pacific region, their daily active user growth was up 108% year-on-year.
And the bookings?
Even higher. APAC bookings growth was up 110% year-on-year. Indonesia bookings were up 804%. Japan, up 125%. The volume engine is just Katak.
It's firing on all cylinders internationally. However, this volume has to be balanced against a really critical data point we found from M-Science. It concerns the company's cash cows.
Right. The core markets.
Bookings growth is decelerating sharply in the most profitable markets, the U.S. and Europe.
U.S. bookings growth slowed dramatically. It dropped into the low 30% range year on year in September. And that's down significantly from the mid to high 50% range just 2 months earlier in July.
And analysts tried to attribute this to a rationalization of growth associated with back to school.
Yeah.
But if the US and EU markets are hitting a maturity wall, the implication for the company's valuation is huge.
Absolutely. When you start relying more heavily on lower ARPU, that's average revenue per user regions, the decline in your overall bookings per DAU is a natural financial consequence.
And the CFO confirmed this, right? He noted the decline in bookings per payer was driven specifically by that geographic mix shift.
He did. So if we see continued deceleration in the US, then the high multiples we discussed earlier,
Yeah.
that 140x price to book ratio,
Yeah.
they become completely indefensible.
Because the quality of the new revenue doesn't justify that kind of premium.
Exactly. Let's just break down those multiples quickly. A price to sales of 12.31 is high, but a price to book of 140.81 suggests extraordinary optimism. It's a premium reserve for companies expecting hypergrowth and huge margins.
So if the US and EU markets are saturated,
Then those multiples become exponentially riskier because the average quality of new revenue being generated internationally is just inherently lower than the saturated core market revenue.
that's a fantastic clarification. It's like a global restaurant chain opening dozens of high-volume, low-margin convenience stores.
Perfect analogy.
The overall footprint looks huge, the user count explodes, but the profitability per square foot drops, ultimately diluting the average revenue from their high-end flagship restaurants in the US and Europe.
Exactly. The focus for investors has to shift from how many users they have to where those users are and how much they are spending. High volume can mask severe quality problems.
So we've synthesized these highly contradictory data points. What does this all mean when we put the three conflicts together?
I think we identified three core conflicts that really define the stock's current risk profile. First, you have the analyst optimism with that $159 median target versus the massive insider pessimism with over $430 million in sales.
Institutional belief versus internal knowledge.
Exactly. Second, the conflict between that huge revenue growth and the strategic tax. Revenue surges to $1.36 billion, but the net loss widens because of mandatory safety costs. Growth is no longer cheap.
And third,
And third, the fundamental conflict between volume and quality. Hypergrowth in lower monetizing APAC regions is masking a severe bookings deceleration in the high ARPU US and European markets.
so looking at these three conflicts, the market is essentially trying to weigh $430 million worth of executive fear against nearly $2 billion in annual bookings growth.
That's the tug of war.
And the key takeaway for you, the listener, is that the stock's true risk profile is entirely defined by the uncertainties surrounding which of these contradictory forces will win out. Right now, the market has not yet fully quantified the real structural cost of de-risking this platform.
And until that cost is known, the volatility is going to remain extreme. Which brings us to our final provocative thought. The CEO, David Baszucki, has stated this ambitious goal of capturing 10% of the global gaming content market.
And our sources estimate they're currently sitting at about 3.2%.
So here's the question. Given the intense, non-negotiable financial commitment required to be the gold standard for safety, which the CFO admitted causes short-term friction, can Roblox really afford to pursue both of these expensive mandates at the same time?
The strategic tax of safety and infrastructure and this aggressive 10% market share goal.
Can they do both simultaneously? Or, in the immediate future, will one of these massive goals have to be temporarily sacrificed for the other?